Good afternoon and welcome to the look ahead for the week. Just bear with me, week starting the 10th of November with me, Fiona Cincotta, Senior Market Analyst at City Index. So I'm just going to ask you to have a quick read through the risk warning and then we'll crack on. I'll put myself on mute whilst you do that. Sorry, there we go. So let's just crack on. As always, just before we crack on with what's going on this week, let's just take a look at what's been going on this week. So, I mean, we've seen some pretty violent moves, I would say, big moves in the US equities and global equities, in fact, not just US equities. And this is, I mean, we've got the NASDAQ chart up here. We've seen, equities, they fell around 2.2% again yesterday. We saw a big sell-off, saw a sell-off earlier in the week of around 2%. Overall, we're looking at before we enter Friday session, we're looking at a weekly decline in the NASDAQ of around 2.8%. So we can see that here from that record high that was reached just at the end of October of 26,000, and we're currently now trading down at today's levels, which are sort of, here we are around the 25,000 level, so just below 25,000 in fact. So, I mean, what's been causing that sell-off? Well, this week we had this sort of, these concerns over tech valuations. It feels like they've been brewing for a while. We've had, at the beginning of the week, we had news of AI deal between OpenAI and Amazon for 38 billion. This just seems to be part of this sort of circular loop of deals between big tech and open AI, that's the ChatGPT maker. So it just, this circular loop sense of investing and is making the market nervous. I think there's also just generally, broadly speaking, worries over valuations anyway, just given the fact that we've had such a phenomenal run higher. We had a couple of months ago, not even, I'd say 6 weeks ago maybe, Federal Reserve Chair, not even that, probably about a month ago actually, Federal Reserve Chair Jerome Powell did also warn over lofty valuations. Now, obviously, we've had earnings season. Earnings season for big tech was a bit of a mixed bag. We did see, this was the other week, we saw, that Amazon, Alphabet, and Apple performed well. Microsoft and Meta weren't. The market was nervous about the amount of AI spending. So this is what we're sort of seeing, is this pullback. And then on top of that, you've also got Michael Fleury, who's the big short trader. He correctly made a lot of money from shorting in the financial market, the financial crisis, and he has also gone short on Palantir and also Nvidia, so big AI plays. And that's also caught the market's attention. So not only have we got these concerns over valuation in AI tech, then we also had the Federal Reserve last week raising concerns over or should I say reining in on expectations for a December rate cut. Those went down from around 90% prior to that meeting to around 69-70% after. They actually fell further this week after we had the ADP payroll come in stronger than expected at 42,000. Let's not forget we've got the ongoing US government shutdown, so there's a great shortage of US data right now, and I think that as well is just adding into this nervousness that we're seeing in the market. They're not getting the data flows that they want to be able to take decisions. The Fed isn't either. So we did have some data this week. As I said, we had the ADP, which is actually a bit stronger than expected, saw the market really, lower rate cut expectations further to 62%. Had the ISM services PMI, which was a little bit stronger than expected, but slowing. And then we all had the Challenger job cuts yesterday, which showed that 153,000 jobs were cut in October. This is huge. This is the highest number in over 2 decades, and this comes as businesses implement sort of AI-driven changes as well as cutting costs. But that has actually boosted Fed rate cut expectations, but interestingly didn't really serve to lift market sentiment. In fact, it had the opposite effect and actually weighed on market sentiment, pulling stocks lower yesterday, and adding to that sort of 2%, almost 2% sell-off that we saw in the NASDAQ. So the market is getting a little bit concerned over the economic outlook, but it can't really because there isn't that data. Now, this is the same problem that we're going to be having for the week ahead. I mean, if we just have a look here, this is the economic calendar. I've limited it to sort of high impacting figures. We're supposed to have US inflation, probably not going to come out, and we're also supposed to have US retail sales, probably not going to come out because of the ongoing US government shutdown, which I think, there are lots of figures flying around as well about what this actually does, what a US government shutdown does to the US economy, and this is set to become the potentially longest US government shutdown on record, and it's going to have a hit to the GDP. So suddenly the market is getting a little bit nervous about the actual health of the US economy, and it's not a case of what we've seen previously where weak data has boosted Fed rate cut expectations, which has boosted sentiment. Actually, we're seeing a slightly different reaction now, where we're seeing weak data is raising concerns over the outlook, which is pulling stocks lower. This, as I said, NASDAQ, we are still in that uptrend. So, this, and we think about the extent of that rally we've had, this is still a pullback within the uptrend. But I think you just need to start looking for potential signs of this actually breaking down out of that trend. Just let me show as far as levels are concerned. Let's just move this. Hang on. Just bear with me, I'm having struggles with it. Okay, sorry. Not able to move. Okay, so anyway, as far as levels are concerned, and this is the level here, it's the 50 SMA. We're level there, we'll be looking for around 24,700. If we get a break below that, we're breaking out of that rising channel that we've been in since early May, mid-May, and that's going to bring into focus this level here, which is the 24,000. That's the low we saw in October. Now, if we get a break below that, we're getting a lower low, potentially exposing there the 200 SMA down at 22,000. So that is to be watched out for on the NASDAQ. Obviously, if we find that this is just a pullback and we find a recovery, then potentially there's a move to look on the upside, back towards that 26,000 level and up to fresh record highs. Momentum is slowing, though we've got the RSI now pointing lower and below the 50 level. So that's just to be watched for. As far as the US dollar is concerned, now US dollar did actually hit a 5-month high, ran straight into the 200 SMA, just over that 100 level, which is also said psychological level, and we've seen a move lower after a test of that resistance. So, you know, same thing here. We've got that sort of, you know, concerns over the US economy, not really getting the safe haven flows, and instead it's been sell the US dollar over the last 2 trades. But that is after we've seen a very solid run higher in the US dollar. As far as levels to be watching, a break above that 200 SMA is going to be absolutely necessary in order to extend gains up towards that 101.80 level, or 102 level, which was the high that we saw in May. So that's the sort of a big backdrop. We obviously had Bank of England as well, but we'll talk about that in 2 seconds, because if we just have a look at the data that we've got going on, what's going on? Just bear with me. Here we go, economic data that we will be watching this week. I'll just actually kick off with the UK, because we've got a couple of data points from the UK, and that is the jobs data as well as GDP data later in the week on Thursday. So we've got the jobs data now. We've obviously had the Bank of England interest rate decision this week. Just let's pull up. There we go. This is sterling US dollar. So yeah, as far as jobs data is concerned, I think there are going to be, this is going to be closely watched, particularly given that there has been this sense of a bit of a deteriorating outlook for the labour market. At the unemployment level, we've seen rise from 4% to current levels of 4.7% over the past 12 months, and could continue trending towards 5%. But interestingly, whilst we're still seeing unemployment move higher, we are still seeing wage growth sticky. I mean, it has come down from the 6% peak earlier this year, but it's still around that 4.7%, with public sector pay contributing the most to this number. Now, you know, any sense of weakness in the jobs data could potentially pave the way towards that rate cut in December, especially if we see weakness not only in unemployment but also in that wage growth. As I said, the Bank of England left rates unchanged, but the vote was more dovish than we were expecting at 5-4. And the deciding vote there was with Andrew Bailey. Obviously, we do have the budget at the end of this month, so you know there was a reason as well for that dovish pause by the Bank of England. They're going to want to know what's in that budget and potentially map out how that could impact the economy before actually taking a decision to cut rates further. Inflation was cooler than expected in September, and the Bank of England expects that to have peaked now at 3.8% rather than the 4% that was initially expected. So that means that if we do see that cooling in wage data as well, that's just going to add into that expectations that the Bank of England could cut rates by 25 basis points in December. This is sterling US dollar. It's fallen off quite sharply. We faced a rejection there at the 50 SMA. Just move that because that's in the way. There we go. So we've faced a rejection on the 50 SMA there at 134.75 level, and then it's trended very sharply lower. This was also in line with the strength of the US dollar, but this actually sell-off was much sharper than that strengthening in the US dollar. And we've also seen sterling sell off against the euro, trade at multi-year lows versus the euro. So this, you know, this isn't just a US dollar story here. This is a weakening in the pound, and that's again on these expectations. I think a lot more to do with fiscal position in the UK, which is looking really quite fragile, given the huge government spending that we've seen. We've obviously got the budget coming out, where it's expected to to hike taxes, which is going to hiking taxes slows growth. So slowing growth, pulling inflation lower, potentially quicker than initially expected, meaning the Bank of England will be able to cut rates potentially more aggressively, or will have to cut rates potentially more aggressively next year if the UK economy looks like it could be slowing by more than expected. So that's the reason that we've seen that weakness in the pound. Now, as far as levels to be watching, I mean, we have recovered from that low of 130 key psychological level. We've moved back above this level here, the 131 level, just testing this level here, which was the low that we saw in August and we saw in May. That's proving to be a little bit of a key level there around the 131.50. Buyers need to move above that level to get to that 132.65, the 200 SMA there. So as far as downside is concerned, weakness in that jobs market is going to fuel those December rate cut expectations, which will pull the pound lower. 131 on the downside and 130 is the key level, with a breakdown there potentially opening the door to a move towards the 127.25 level, which was the April low. Also, as far as UK data is concerned, we've got GDP data. Now, interestingly, UK GDP, the IMF downgraded its 2026 GDP forecast for the UK to 1.3%, whilst also warning that the UK is likely to face the highest inflation in the G7 over the coming 2 years. Now, more recently, the monthly GDP data showed the economy grew 0.1% month on month in August, although July was revised lower to 0.1%, with the service sector looking a little bit weaker. But actually, I would say PMI data that we've seen this month has been more encouraging. We saw an upward revision to the service sector, especially, which is the key sector in the UK economy. So, I mean, I think the Bank of England remains still very divided over the growth outlook for the UK, with some policymakers such as Alan Taylor suggesting that the UK is heading towards a recession and needs rate cuts now. And then you've got more hawkish members that are concerned with the elevated price risks. But I think the actual outlook for the UK economy will depend quite significantly on what happens in the budget on the 26th of November. And given the tight spot that the Chancellor has found herself in, it does look like there is little way out other than significant tax hikes, which we would expect to slow the economy. This is the FTSE 100, trading just near record highs, reached record highs this week. Again, just below the 98,000. So, you know, really solid, or in fact at 98,000. But if we have a look at the pullback that we've seen in the FTSE, it's been considerably less than the pullback that we've seen in, for example, the NASDAQ that I showed you, and that is purely because we just don't have the same exposure to tech in the FTSE 100. So if you're concerned over lofty valuations in technology stocks, then, you know, looking towards the FTSE index could be a sensible play, given that, as I said, it doesn't have the same exposure to tech stocks. The Bank of England is expected to cut interest rates. However, if we do get any concerns over the prospect of an economy slowing down to recession speed, then obviously that could mean that the more domestic stocks in the FTSE 100 come under play. But the other thing to bear in mind here is the FTSE is obviously, it's made up of 80% of multinationals, which benefit from that weaker pound that we've seen. So that also, if we have a look here, has been a big part of what we've seen helping drive that move to record highs. I'm just going to pull up here now the US dollar, Japanese yen, just because talking more broadly here on themes and the theme of risk off, concerns over outlooks, concerns over the US government shutdown, etc. This is the US dollar, Japanese yen, which trades actually in an up channel. Japanese yen obviously being a play for safe haven. So we've seen that strengthen a bit this week, but it's just testing this level here, the 153.10 level. And this is the high that we saw in the early October. If we do see this ongoing risk-off mood, we might see that the Japanese yen attracts more inflows, and we see on safe haven flows, and that could actually push the level back towards that 151.15 level. That's the midpoint of the rising channel and sort of the high that we saw around the 27th of March and also in July. So that's one to be watching. Obviously, if this level holds and we get a more upbeat mood towards the US next week, I mean, if the US government opens, not looking likely right now, but anything could happen, then 155 is the level to be watching on the upside. And the other one we're going to be talking about with as far as risk off is concerned is gold. Okay, so that's the short-term trade that I had on the short-term chart. All right, sorry. So let's just pull this up. This is gold. We've pulled back quite considerably from that record high of 43.81, but we're finding support on this rising trend line, trading in a little bit of a holding pattern right now with 39.20 on the downside, 40.20, 30 on the upside. Buyers are going to need to break above this sort of 40.30 level to create a higher high and bring that 41.60 level, which was the high from late October, back into play. Just as far as the downside is concerned, if you get a break below that 39.20 level, then, and also this level here, which is the 38.90, which was the low from October, that could spark a deeper sell-off to the 3800 level. But that we really would need to see an improvement in risk appetite in order to see that play out. But I think, you know, again, longer term, we do still have a support, I think, to the gold trade as long as central banks are still buying. Expectations for the Fed to cut rates going forward, and that could help gold prices push higher. Again, just having a quick look at what else we've got going on. I'm conscious that time is running out. China data. Okay, so we've got quite a bit coming in from China. We've got the inflation data. We've also got the retail sales and industrial production. As far as expectations are concerned, so Chinese data, inflation data is actually due over the weekend. The expectations are for CPI deflation to persist at 0.2% decline year on year. Whilst food prices have been recovering, non-food prices have been recovering, food prices continue to be a drag on inflation. We've also got retail sales, which are expected to moderate to 2.6% year on year as the impact of the trade policies continues to fade, and we can and confidence continues to restrict investment. So, I mean, it's not a particularly bright picture for China at all. And this data obviously comes after figures this week showed some weakness in Chinese exports, which actually fell 1.1% compared to a year earlier. Now, this is quite big. I mean, we're not expecting a fall in Chinese exports, but this really shows us that global demand failed to offset the slump in shipments to the US. And yeah, basically global shipments rose 3.1%, but that's just not enough to compensate for more than 25% decline that we've seen in exports to the US. Basically, all this data, I think if it comes in as expected, showing that weakness, is just really supporting the view that the resilience that we have seen in the Chinese economy is starting to fade, and supports the view that Beijing really needs to step in order to support domestic demand. Now, if we get weaker than expected data, this is the Aussie US dollar, great proxy for China. If we get some more weakness, then we could see a break below this rising trend line, which has been in play since mid-June. Break below that and the 200 SMA just really opens the door to this level here, the 64.25, which is the low that we saw in August and in July. So if we get a break below those levels, things will start to look a little bit more bearish. We're down here with the RSI supporting. So if that sort of support gets breaking through around the one at 64.60 level and the 200 there at 64.50, then we could see some further sell-offs. On the upside, if we find this whole support hold, which it has on numerous occasions, any recovery will be looking at the 65.60 level, which is the 50 SMA, to be able to then bring the 66.25 level back into focus. So that is literally all we have time for, but I'm going to just squeeze in the euro US dollar because we've also got Eurozone GDP figures in focus. Now, interestingly, GDP in Eurozone has held up a little bit better than expected. I think we're starting to see signs of a very slowly moving, but in the right direction vibe from the Eurozone economy. We're starting, PMI data was encouraging, particularly the composite PMI, which is a good gauge for business activity. Inflation remains low at that sort of 2% level. Towards the ECB's target level. And so, you know, with that in mind, the ECB is not expected to cut interest rates again anytime soon. Got nice movements, albeit very slow growth in the Eurozone. And so that sort of technically is, well, I should say fundamentally is a decent backdrop. Obviously, we've had that US dollar strength, which has weighed on the euro US dollar recently. We've seen a recovery of that low of the 114.70 up towards where we are now, the 115.50, which is the low that we saw back in the 10th of October and the high that we saw around the 22nd of April. So pretty key level that we need to break above, but we're not going to get out of this sort of more downbeat move until we get a rise above the 116.70 level, which is the 50 SMA, also creates a higher high to bring the 117.80 level into focus. So yeah, just worth having a look to see how this reversal continues, or if it does. Otherwise, we're still in that downtrend. And if we take out that 114.70 level, that's going to create a lower low towards this level here, which is 114 low we saw back in July. So that is all that we have time for this week. Thank you very much for joining us, and I look forward to speaking to you next week.